Ladies and gentlemen, good day and welcome to the UFO Movies India Limited Q3 and 9 months FY24 earnings conference call hosted by Ventura Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Tushar from Ventura Securities Limited. Thank you and over to you, Tushar.
Thank you. Good day, ladies and gentlemen. On behalf of Ventura Securities Limited, I welcome you all to UFO Movies India Limited's Q3 and 9 months FY24 earnings conference call. The company is represented by Mr. Rajesh Mishra, Executive Director and Group CEO, along with Mr. Ashish Madushte, Chief Financial Officer of the company. I would now like to hand over the call to Mr. Mishra for opening remarks, post which we can start the question and answer session. Thank you and over to you, sir.
Thank you, Vishal. Greetings everyone and thank you all for joining our Q3 and 9 months FY24 earnings call. The third quarter of FY24 marked the notable turnaround for our business, defying the initial challenges posed by the Cricket World Cup in the early part of the quarter. The business this quarter witnessed an upward momentum with the release of 502 movies, an increase from 484 in Q2 FY24. Despite a subdued start with movies like Mission Raniganj starring Akshay Kumar, Thank You for Coming starring Bhumi Pednekar, Bhagwan Kesari, Yariyan 2, Ganpat and Tejas starring Kangana Rao, the momentum picked up significantly in the latter part of the quarter. Notable successes during the initial months included 12th Fail, Leo and Tiger 3, featuring Vikrant Masse, Vijay and Trisha and Salman Khan respectively. However, the real game changer came in December, witnessing a surge in successful releases like Animal, Sam Bahadur, Hai Nanna, Danki and Salar. This positive trend translated into our advertisement revenue, recording an 83% year-on-year growth in in-cinema advertising, from Rs 186 million in Q3 FY23 to an impressive 341 million in Q3 FY24. Caravan's advertisement revenue also followed this positive trajectory, driven by impactful campaigns from the Ministry of Urban Development and clocked in a revenue of Rs 41 million in this quarter. As a result, Q3 FY24 emerges as a standout quarter in the current financial year, with EBITDA at Rs 184 million, a 4% Q1Q increase and an impressive 83% year-on-year increase. Looking at some key figures on the quarter and 9 months ended December 31, 2023. Our consolidated revenue for the quarter stood at Rs 1184 million compared to Rs 871 million in Q2 FY24 and Rs 1109 million in Q3 FY23. EBITDA margin for Q3 FY24 improved from 9.1% in Q3 FY23 to 15.58% in Q3 FY24. Profitability after tax continued its growth momentum this quarter, reaching 46 million compared to the loss of Rs 3 million in Q3 FY23 and a profit of Rs 33 million in Q2 FY24. Regarding the 9-month performance, the consolidated revenues amounted to Rs 2909 million as compared to Rs 3093 million in 9 months FY23. For the 9 months FY24 was at Rs 524 million, a substantial increase compared to Rs 224 million in 9 months FY23, 134% increase year-on-year. EBITDA margin in 9 months FY24 improved from 7.2% in 9 months FY23 to 18% in 9 months FY24. On the profitability after tax front, PAT for 9 months FY23 improved to Rs 103 million against a loss of Rs 120 million in 9 months FY23. The consolidated gross cash at the end of the quarter was Rs 882 million, with net cash standing at Rs 230 million after considering all outstanding debt. In terms of our advertisement screen network, it expanded to 3,407 screens as of December 31st, 2023, compared to 3,303 screens as of September 30th, 2023. This quarter witnessed a net increase of 104 advertisement screens with a notable boost in both prime screens and as well as popular screens. Also, post Q3 FY24, on January 3, 2024, we announced a tie-up with TSR Films, securing exclusive advertising screen rights across TSR's extensive screen network of over 403 screens. This collaboration has strengthened our presence in Gujarat and southern markets, especially in Tamil Nadu and Kerala, expanding our network to 3,808 screens nationwide. This reflects the growing confidence in the theatrical viewing experience. Looking forward to Q4 FY24. Started on a decent note with movies like Hanuman and Fighter. However, the upcoming lineup of movies, while subdued, yet is a decent lineup, including Teri Baaton Mein Aisa Uljha Gaya, starring Shahid Kapoor and Kriti Sanon, Mere Mehboob Mere Sanam, starring Vicky Kaushal, Lal Salam, starring Rajnikant, Article 370, starring Yami Gautam, Yodha, starring Siddharth Malhotra, Lapata Ladies, produced by Amir Khan, and Shaitan, starring Ajay Devgan and Madhavan, and The Crew, starring Kareena Kapoor and Diljit Dosanjh. So the lineup looks good, and we are looking forward. We remain optimistic to continue this positive momentum. Thank you. Over to you, Tushar. Hello.
Can I start the Q&A session, sir?
Yes, please.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our first question comes from Aditya Karnath, an individual investor. Please go ahead. So please go ahead, sir. So there is no response from Aditya's line, sir. Shall we go to the next question?
Yeah.
Hi, can you hear me?
Yeah. If he manages to connect back, then we'll certainly take a screen.
Mr. Aditya, please ask a question.
Yeah, sorry. Thanks for this. I think it's a good quarter. Just I had a couple of questions. One is your ad sharing percentage for this quarter is similar to last quarter, even though your ad revenues have gone up quite a lot. Your minimum guarantee actually has some operating leverage inside it, but that hasn't come through this quarter. So could you just share why your ad sharing percentage hasn't dropped to like 35-37%, even though your ad revenue has gone up? And second question is on margins. Just why the margins are lower in this quarter than last quarter, and what do you expect long-term margins to be?
Yeah, so your question relating to ad sharing is the first one. So let me take that first, because the others are not noted yet. Ad sharing percent, if you compare with previous year, it has fallen, but you are right. We need to also look at it on a QOQ basis. And on a QOQ basis, what you would see is that it is almost remained flat, but in Q1 it was at 48%. In Q2 it went down to around 41.5, and in Q3 also it is almost at the same level, 41.5. The reason why from Q2 to Q3 you're not seeing any drop is primarily because as the cinema, large screen cinema viewing experience was well received by the audiences and started coming back to the theatres. Even as you must have seen, even in our results, the theatres which were closed down slowly started opening, and better screens which were in the process of getting opened up, they have also started opening up. As a result, in the last 5-6 months, we were able to get hold of better screens. When I say better screens, screens were near multiplex category or multiplex category, where your minimum guarantee commitments continue to be slightly higher than average. And what happens is when you have these screens getting added to your network, which is evident if you see 100 screens have got added in just one quarter. These screens, my liability, my obligation towards minimum guarantee starts from day one. But obviously my sales team takes some amount of time for them to get the kind of revenue from these screens. So you will always see some amount of gap there, lag rather. Sometimes it is 2 months, sometimes it is 3-4 months, but then that new screen comes back in the overall fold of the cinema network getting sold to the theatres. So that is one reason, and I'm so glad that you have identified this as a problem. But structurally, yes, you are right. As we progressed from last year to this year, as the revenues went up, the sharing percent went down. And this is not the end of it. You're right, as the revenues would start going up, the sharing would start coming down, except one caveat that I want to put is, there's one major, very positive development that we announced this month, about a partnership arrangement for advertisement sales of premium and key category screens down south with one of the players, PSR, a very strong player. Now over there also similar situation would arise for next quarter, this quarter, that our obligation would start from day one, but for us to ramp up the revenue would take time. But structurally, yes, we should be able to see the kind of sharing which used to be there in pre-COVID, but slightly above that, so around 35 to 38% should be our sharing eventually.
Point of margin.
Sorry, I missed your second point. Can you please repeat your second point?
Yeah, sure. Thanks for that explanation. The second question is just on margin. This quarter's margin being lower than last quarter's margin. Is that seasonality?
Yeah.
What do you expect long-term margins to be?
No, so you're again right. It's a very valid point that the margins remain at the same level what it were in previous quarter, slightly lower than previous quarter. And the reason is simple. As you know that we had announced to the shareholders in our beginning of the year earnings call that we have actually moved our salary from fixed to variable, and 20% of the fixed salary was moved to variable because we are not sure how the performance is going to be of not the company but cinema viewing, whether it will be coming back with the same kind of proportion as that of the other industries. Fortunately, there is a turnaround, and fortunately we all have gone back to pre-COVID levels when it comes to our cinema viewing habits, and therefore all the cinema service providers or exhibitors are slowly reaping the benefit. So the only thing that has moved is the provision that we have taken in this current quarter, which is to the tune of 5.7 crores for the variable pay, which part of it we have paid off, and towards the incentive for the sales teams. So that is one thing that has, so 5.7 crores if you technically add back to the EBITDA, then you probably will be able to see the growth that is visible in the percentage sharing, in the EBITDA margin as well. So this 5.7 in other words is not purely of this quarter. The hit has been taken in this quarter, and some of it is a provision that we have built in, assuming that the current trend, positive trend, will continue even in Q4 going forward, because we don't want our employees to, in a way, suffer beyond a point when good days are returning. So please consider that 5.7 crores as one-time expense or an expense pertaining to previous quarters partly, and then you will, if you rework, you will get a better margin.
Got it. Thank you.
Thank you, sir. The next question comes from Ritesh Oswal, an individual investor. Please go ahead, sir.
Congratulations for good numbers. I think we have approx 100 crore plus cash and cash equivalent consolidated basis, and expected 60-70 crore net cash in next 12 months.
Before you proceed, I missed the first line. What did you say?
I think we have approximate 100 crore plus cash and cash equivalent.
Yes, sir.
Yeah, and 60 in next 12 months. So any thought on reducing balance sheet, pay updates?
So if you actually see, our debts are slowly going down. In December 22, my gross debt was 83 crores. And December 23, my gross debt is 65 crores. So my debts are going down, and we are conscious of that. Fortunately, we were in a situation where we kept the cash and kept the debt, and that really helped us in that horrible period of COVID, because our revenues were zero for almost 6 quarters. But yes, after that, now that for last 3 quarters we are seeing profitability returning and even the normalcy returning amongst the cinema viewers, we have consciously moved ahead and started reducing the gross debt. What it means is that the debt gets reduced, but we don't really add more of debt from our side, because our business is such that for capex, every year we do capex, and for capex we need debt. But this year we were conscious of capex also, and some of the capex we have done through our cash. So we are moving in that direction. But just to give you a comfort that while my opening remarks cover only the net debt probably, the gross debt is reduced by 18 crores. And yes, we are sitting on cash, but we will not be completely paying off the debt at this stage. Maybe we would still want to keep a buffer with us, which historically we have been doing. But that is not a huge buffer. You must have seen the way the management has treated the cash in the past ever since IPO. Whenever there was a cash accumulation, if there was no meaningful opportunity to deploy the cash in the form of acquisition or deploying in business, we have time to time returned it to the investors. But at this stage, we will continue with this trend where we are really consciously bringing the gross debt down, and cash is bound to go up because business is making money.
So next year capex amount, approximate capex plan?
We should be going back to pre-COVID level, and that's again a healthy thing. This year we consciously thought of curtailing our capex because that kind of demand was also not coming from the market. Next year we should be going close to pre-COVID capex of 40-50 crores, but better clarity will emerge by the time we reach before we reach the next earning call, full year earning call. But you can take it that we will be going close to pre-COVID level, at least 80%.
Yeah. Okay. Thank you very much.
Thank you, sir. Our next question comes from Aditya Sen from Robo Capital. Please go ahead.
Hi, thank you for the opportunity. Sir, do we have any updates on ad spendings by the government? Because that would be another major driver, that is the laggard that we are experiencing as of now. So any updates on this front?
So, on the central government front, ad spending, there has been certain uptake in that, but not to as great action as you would have felt happy about. So central government, while they have done some activity, they still continue to remain on the lower side. As regards state government revenues, that we are pushing aggressively and trying to make up for the gap that has occurred due to central government spending going down across mediums. So it's not only cinemas that they have gone up on, they have generally reduced their spend. I have mentioned in my earlier call this also.
Yes, right.
They have reduced their spend across print, television, everything. So it's a conscious call by them. But as I said, healthy point is that they have started some activity in this regard in this current year.
Yeah, so on the data points, because since you have this question and which is very critical, two things. One is that this healthy performance that the company has put up in this quarter on the back of a good quarter, which was Q2. This is in spite of central government not really starting the spending. So, in a way, if there is a change there and the central government ministries start using in cinema as a medium once again, then that is going to be a phenomenal positive for the company. Honestly, we don't know when. Nobody from industry would know that. But on the state government side, the data points are, last quarter we did 7.2 crores. This quarter we have done 8.8 crores, state government. So it's almost 21% growth. And on YOY basis, against the 8.8 crores of this quarter, in Q3 last year we had done 4.4 crores. So it's almost doubled. So there is some healthy traction. Obviously, I'll put a cautious statement that when the elections gets announced, then all the state government ministries are required to stop their campaigns, and to that extent there will be some reduction from this particular segment, not overall segment. PSUs would still continue to.
Okay, so this is a valuable information. Thank you for this part, especially the part that they'll reduce the expenses in the coming quarter. And so, given the fact that central government, everything is dependent on central government, I don't think we'll be able to cross the pre-COVID highs of 200 crores revenue from this advertisement. Am I right on this?
So, if you are having a time horizon of next 1 year, then answer is yes, we will not be able to cross. But the inherent strength of the medium is such that the only thing that was lacking was people coming back in cinema. Now that is really happening and that is continuing. All it is the mathematics of number of minutes sold and the spot rate. So if you have to really increase the revenue 4 times, I have to double both these parameters. Currently I am selling 5 minutes. Some of the better multiplexes manage to sell upwards of 20-25 minutes. Obviously I am talking about 2x growth because my network is really large and it's a combination of different category screens. And the spot rate eventually plays out, which I don't need to say, as the demand increases and the scarcity is there, the rate goes up. So certainly that is the biggest driver for us, the ability of this network to deliver on the same investment done in the network, with the ability of the network to deliver higher advertisement revenue. And that has been the draw all the time.
All right.
But not in 1 year.
Not in, that too we also foresee as of now.
Yeah.
Okay then, thank you for your answer.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Our next question comes from Rahul Vashishta from AXA Capital. Please go ahead, sir.
Hi, this is Rishi Maheshwari from AXA Capital. This is regarding your association with TSR. If you can highlight how have the contract been negotiated over there? What are the terms? As we understand, TSR itself is a digital chain for streaming ads. So what is our association with them? That's my first question. If you can please let us understand the commercial terms over there.
TSR, the association with TSR is a basic understanding of acquiring the advertising selling rights of their screens. The basic purpose of this was to increase our footprint in the southern markets, especially Tamil Nadu and Kerala, where they have a good presence. So we have added around 180 screens of TSR in Tamil Nadu itself, and Kerala another 54 screens, and Karnataka 36 screens. So it gives us a increased footprint in the south market, and this allows us to capture pan-India campaigns from even in the north. The way it is structured is we are acquired the advertising rights. I don't want to get into the actual sharing of the commercial terms over here because a lot of it is confidential also in nature. But basically, there is an amount agreed and we pay out according to that. The entire inventory of these screens is exclusively going to be marketed and sold by us, and that is the broad contours that I can share at this stage.
So Rishi, basically, just to add on to what Rajesh said, one, it is extremely critical, was critical for us to have a better footprint in South, which we have achieved through this. But the way a financial investor can look at this particular deal is that this is an absolutely asset-light model where we are not going to incur any upfront capex, so to say, which we do in other screens. And in return, what we are getting is the ad rights of this good network, which we can sell as a composite network along with ours, which in turn is going to get medium to long term a lot of benefit. But which one of the earlier question I was trying to answer about sharing, the nature of any arrangement, whether it is with a deal like TSR or an individual screen, is such that my liability starts from day one, and my ability to integrate that screen or that network in mine takes at least 2 to 3 months. So till that time, there's a short-term gap you will see where my revenue from that network or that theater is lower than my commitment. But basically, it's an asset-like model. I'm going to be paying a fixed fee, which is in the form of a MG, for acquiring those networks, and beyond that, the revenue gets added to my profitability with me not incurring any capex on this.
Sure, helpful. So just to extend this, how many of these 400 odd screens will you place in the premium screens?
Quite a lot of them, because this is primarily a DCI network which is installed high-end equipment, and roughly 75% of the network I would place in the premium category.
Okay, thanks. My next question was to understand going forward any association that we can assume with Cube in any other form that the management envisages, or is that story done and dusted with?
I mean, I never say never do anything, but right now we have just come out of a potential association. So right now nothing is there on the radar or horizon. Something comes up, definitely we will be always open to something. But right now there's nothing.
What could be the cost associated in terms of the merger or the JV that was planned? Was there any cost that was built in 9 months FY24 PNL?
Okay, so you mean, just to understand your question better, you mean was there any cost incurred estimated for completing and operationalizing this JV? Is that the question?
That is right, absolutely.
Okay, so no, nothing apart from the
nominal legal fees and consultancy, nothing much.
Most of these costs got incurred in Q2, partly in Q3, and all of that was in relation to the legal fees and the advisory fees for putting the JV structure together and related activities. Not really significant. Beyond that, there was no cost. And that was not even envisaged.
There is no cost or there is no breakaway fee or anything from that. It was a mutually agreed dissociation, So there's no other cost incurred.
Sure. All right. Thank you so much. Okay.
Thank you. Thank you, Vishnu.
Welcome.